Good evening, everyone. I am Tyler Silverthorn, joined with Austin Potter, here to spend the next half hour or so looking over a little bit what occurred in 2024 and what we foresee in going into 2025. To let everyone know, this is being recorded. If anyone has any questions, please enter them into the chat. We will try to take them as they come. If we can't get to your question, we will make sure that your advisor follows up with you with your question. So starting off, wanting to discuss the economy. The consumer within the economy has been slowing. That meaning, spending has been slowing, but there are some positive tailwinds looking ahead. One of the biggest positives that we are seeing is this pent-up demand for CapEx being capital expenditures. What business owners have told us or told investors through surveys is that they were planning on holding off on doing increased spending until the start of the new year. I think a lot of getting through the political cycle and starting the new year fresh, but we can see that the pent-up demand for spending by businesses is, very, very high. In particular, this probably won't be any surprise, but in the communications department, I think as all of us have been seeing artificial intelligence get more and more incorporated into our lives, the demand is for that technology is going to help push spending through by businesses. Looking at the consumer side, what we can see is that the majority of spending is being driven by the 35 to 54-year-olds. In particular, the millennial generation is expected to make up almost 75% of all consumer spending by 2030. And so that generational change of where spending is or who is doing the spending will have a little shift in demographics from consumers, which is a positive. Having spending being driven by those in some of their peak earning years, it helps reinforce the economy and makes for sustainable spending, which does look at a little bit of an interesting note. I know this graph is a bit busy in terms of what age group makes up the majority, or what age group makes up the proportion of the employed. And what we can see if we were to track it is all these peaks that we're seeing was the baby boomer generation working its way through the workforce. So right now, the 55 and up, indicated by this orange line, is the largest demographic in the workforce, where 20 years ago it was the smallest. What we can see is the ramifications of the baby boomers working through the workforce, and now helping for the following generations to take over. Again, in particular, the millennial generation projected to be one of the larger generations following the baby boomers. But I think the millennial generation starting to become a bigger portion of the workforce, tied in to projected to be a biggest consumer in terms of spending, help bodes well in terms of supporting the economy. And Austin, I think you'll plan talking a bit about how household income and spending are impacted or work their way through the economy as well.
Yeah, just to kind of elaborate on Tyler's original discussion about the millennials really driving the spending, we tried to peel back the layers of Okay, what this chart right here kind of shows the quartile or quintiles of the different spending. And if you look, the lowest 20% on that top is the 20% household earning income, and then what they make as a total of the consumer spending. So, if you take the top, the lowest 20% makes up about 10% of the total consumer. And then the next quintile, the second quintile, being about 15% of the total consumer spending, and so on. But really, the two things that jump out at us when we're looking at this chart, first off, is the majority of the spending, or almost 40%, not quite the majority, but almost 40% of the total consumer spending is driven by the top 20% of wage earners. And then the next tier quintile down, or the fourth, is also driving a significant portion of the spending. And the takeaway is, when we're looking at the economy and where things are potentially going and what we're thinking about next steps, is we're really focusing on the top wage earners, because they're really driving the economic conditions and their spending. And oddly enough, part of the issue, or part of the reason this has kind of transpired, is we look at inflation, we look at rents, we look at things like that. And a lot of that is driven, most affects the lower quintiles of income ranges, because they don't have as much discretionary income. And that's really why we do tend to focus on the top end from an economic standpoint and from an investor standpoint. So if we go to the next slide here, the other thing when we talk about consumer spending, it goes hand in hand with each other, is inflation. And we really, in this chart, we tried to strip out inflation in two kind of categories or tidbits on the lines. And you'll look at the dark blue line is consumer goods, and then the yellow line is consumer services. Traditionally, the US economy is really driven by services for the majority of the consumer spending, if you think about the total. But after we got through the post-pandemic era, and if you look at the chart, really around the beginning of 2021, and that blue line really took a skyrocket. And part of that is just when consumers were kind of locked up in that post-COVID world, we had, or the federal government by extension, provided a lot of stimulus, and that stimulus, people are going out there, they're spending the money, they were looking for avenues for effectively entertainment, is the better way to put it. And it really caused some interesting dynamics in the market, because traditionally we are really leaning towards the services and not the goods. And part of that too is the goods increased the inflationary pressure because there was a lot of demand, and then we had the supply shocks through COVID because we were closing down manufacturing companies, things like that. So it created an interesting dynamic, but really just kind of showing that the inflation for goods, if you look in 2023 and 2024, have really started to quite rapidly decline, showing that supply has kind of caught up. But that services, or the service side of inflation, has really kind of crept up and hasn't come down nearly as fast. And like I had mentioned earlier, that does make up a large portion of consumer spending, and that really drives inflation. And that's kind of what we're looking at. So, we really do like to talk about inflation. And part of the reason we like to talk about inflation is because of the Federal Reserve and them controlling the Fed funds rates and those interest rates that really set the baseline. And we look at the targets here, and what this chart is showing us is the Fed's favorite inflation barometer or metrics, and that's PCE, or personal consumption expenditures for US consumers. And you'll notice it really started to peak in that 2022, it's about summer of 2022 time period. The top end of there is, almost 8%, and relative to normal inflation, or what we would consider normal inflation, is quite high. And luckily, we have started to see inflation come down. So the Federal Reserve raising those interest rates and kind of reducing the overall inflationary pressures, along with demand coming down. So those were all good things, but the biggest thing you'll notice in the chart is if the Fed's long-term inflationary goal is 2%, we are still, that the tail end of the chart of that 2025 is projections or forecasts. But if you look right before the grayed out area, I'm sorry, it's still around that 3-ish%, just shy of 3%. So, and what we know from historical data and watching inflation over the years is that last little 1-ish% of trying to get inflation to 2 is very difficult because it's pretty sticky. Once we get some inflationary pressure in there, it is quite difficult to come back down. And that's part of it, reinforces the logic of, I might as well buy my goods now because in a year from now they're more expensive. And that's how inflation can become a bit of a spiral, and something that we're all watching very closely. But our anticipation is not a reigniting of inflation, but we'll chat about that a little more. So the next, slide, and this kind of shows the supply and demand of workers, because inflation is closely aligned with jobs, and that's because if people have money in their pocket, they want to go out there and they have money to spend, and all inflation really truly is consumer demand. So if we look at the red line, that is effectively the demand for jobs or for hiring new workers, and then the blue line is the supply, or people looking for work. And the big thing you'll notice is historically, these lines are pretty tight together outside of recessionary time periods. So that gray area is really the recessionary time period. But especially from 2016 onward, which most of us kind of remember pretty well, is that those lines are pretty well converged. And then when we look at going through COVID, specifically in that 2020 time period, and that big sharp drop in, working demand, or people or employers trying to hire people in, that red line got extremely low in terms relative to historical averages and difficult times. But part of the reason we got that K-shaped recovery is, as economists like to say, going through the COVID time period, is that we saw a rapid, increase of people. And then eventually we got to a point where the demand for workers was out of balance. And effectively, there was more demand for people to come back to jobs than there were supply of workers. That creates wage pressure, and that creates opportunities for workers to negotiate for better salaries. And then that innately causes inflation. And that's what we saw in 2022 and 2023. But the nice thing is, and probably the greater takeaway is, if you look at the most recent data, or that 2024 onward, those numbers have really started to come back into balance, or almost at equilibrium. And when we see equilibrium, it is usually better for economic growth, because it means there aren't nearly as many inflationary pressures, or real wages, aren't rising as quickly and rapidly. And then the other thing we look at when we're talking about the economy and where things are going is specifically debt, and more specifically bankruptcy of debt, or potential delinquencies of debt. And if we look at this chart here, it shows the delinquency rates per household for household debt. The red line is 90 to 120 days of late payments, meaning, if that red line, if you're in that 90 to 100-day time period, it's getting less and less likely that you're going to pay on that debt and potentially have bankruptcy proceedings. So that's something we watch. And then also the 60-day, or the 30 to 60-day, or the blue line, something we watch as closely, but people may have forgot the payment, things like that. It's still likely that you may pay, or not unlikely. But the bigger thing we're also watching is we're combining the delinquency rates with the credit card debt. And I'm sure you've seen in the headlines, credit card debt has exploded, or not exploded, that's probably not a fair term. It has increased dramatically. And we have finally surpassed $1 trillion in early 2023 from a credit card debt perspective. But with that said, we just went through pretty significant inflation. So doesn't it innately come hand in hand with having higher debt and higher inflation? Things cost more. So the real number is not nearly as impactful as the headlines seem to make it appear. And more importantly, the reason we look at delinquency rates is, are people continuing to pay on that 1 trillion, or 1.1 trillion as of today, or the third quarter, to see if they're continuing to make those payments. And so far, we have seen a creep up in those delinquency rates, but it's not necessarily concerning. And if you look at it from the length of the chart and from a historical perspective, it's not too concerning. It's something we're watching, and whenever you see an upward tick or a trend, that's something we like to watch. But overall, it's not too concerning, in all things being equal.
transitioning to the stock market, I think what was interesting or a little bit of a surprise last year, as we go back and look at how did various investment strategists, by strategists we mean some of the large investment banks, UBS, Wells Fargo, Goldman Sachs, etc. How did the strategists predict 2024 was going to occur and what actually occurred? And what we saw is last year that 2024, the strong performance by the S&P 500, where it finished the year up over 20%, really came out as a big surprise to the investment community. The average strategist was predicting the S&P was going to finish at about 4,800, and it finished well over 6,000. So the average strategist was predicting the S&P would be about 2% next year. And so I think this is a good reminder that things change throughout the year. And anytime we look at what our favorite investment strategist or publications putting out, taking it with a grain of salt that history says trying to predict what the market does over a relatively short period of time, which 1 year is extremely difficult. And a lot of times they like to do, great headlines to get views, but history says they're not always the most accurate. Starting moving to 2025, we are entering the third year of our current bull market. The current bull market started middle of October of 2022, and you can see, historically speaking, year three of a bull market on average tends to be positive. So year one and year two, on average, year one, the average first year of a bull market is about 40%. Our current bull market in its first year, underachieved, and that was up 21%. Conversely, year two of the bull market starts to slow down, averaging 14. Our year two was 32%. Again, this is in not calendar year, but trailing. And historically, year three of a bull market, the S&P ends up being positive just over 5%. So as we look forward as we now a few months into the third year of the bull market, history gives us reason to be optimistic the bull market will continue, but not to expect the same type of great returns from the market, which I think does make some sense that the beginning of recoveries is when we tend to see the greatest returns in the market, and as it goes on, it tends to slow down a bit. If we look at from another historical perspective of how does the market do on average after the S&P was positive 20% or more. Not that history is a guarantee of returns, but does give us some insight on how markets have historically behaved. And when markets have been positive 20% or more, 81% of the time, the following year they are positive, and on average are positive almost 16%. So when we look at, depending on how we look at from a calendar year being positive 20% or being in the third year of a bull market, historical data tells us on average that the S&P, the stock market, we should hope to expect that we'll still see some positive growth, not at the same level as we did previously, but continued growth. then when we look at how the stocks have done historically when we've been in a rate cutting cycle, meaning when the Federal Reserve is cutting interest rates, stocks tend to do well. As rates are getting cut, companies can borrow at cheaper rates, so they are able to invest more into their companies. From an investment standpoint, bonds can become less attractive compared to stocks. If you were able to invest in bonds earning 5%, and then after the Fed is done cutting interest rates, if they're earning 2.5%, all of a sudden investors will look at that risk analysis and saying, does it make sense to hold as many bonds now that they're paying 2%, 2.5%, when I can invest in some quality stocks that are having a decent dividend with equity upside potential? And that's what we saw in the 2010s when rates were very low. One thing that helped push the stock market forward was that stocks weren't getting much competition from bonds. A lot of traditional bond holders, retirees, people relying on fixed income, couldn't generate the income they needed from bonds, so they held larger than normal allocations to stock. And so as Fed began cutting rates in the third quarter of 2024, and expected that they will continue to cut rates, granted at a lower speed or a slower rate in 2025, that tends to be positive for the overall the overall stock market. And I think Austin, you'll dive a bit deeper into some of the layers of the stock market.
Yeah. So when we peel back the layers of the stock market and we really look at, okay, what has driven the returns over the last handful of years? I'm sure everyone on the call has heard of or heard the terminology of the Magnificent Seven. Magnificent Seven specifically are the big name tech companies that are familiar, but they really have driven a lot of the stock market performance. There's been a little bit of a concentration, specifically in 2023 and 2024. And we've seen it kind of balance out a little bit more recently towards the tail end of 2024. And part of our expectation is, and kind of what we're forecasting, what some of the market people are forecasting is, and this chart shows a good idea, is if you look in the bottom left-hand corner, what this chart is showing is it's the earnings growth for the left-hand, or the darker green is the S&P 500, and then the lighter green is the Magnificent Seven. And really we're comparing, okay, how have the Magnificent Seven grown their earnings versus how has the S&P 500? And you look in Q1 of 2023, and this is trailing 1 year, that was actually negative. And then even in Q2 of 2023, the S&P was negative, which did cause some potential concerns from a lot of market economists about maybe we have some recessionary fears going in. And I think that was discussed, but the other line is Q2 in 2023, you see a large jump in the Magnificent Seven earnings specifically on that earnings growth. And that's part of the reason why the Magnificent Seven has really driven those returns, is because if you look in the Q2 of 2023, Q3, Q4, and so on, those lighter green bars are pretty significantly higher than the S&P 500 earnings growth, and it's really that concentration, and it's really that cash flow. It's the positive earnings. It's them having the ability to really grow their earnings rapidly. And that's part of the reason why we saw great returns in 2023 and 2024, is a lot of it was those earnings growths on these large tech companies, or the Magnificent Seven, have really powered the market higher. But then the next question is, how long can that continue? And then is there an opportunity or a convergence or a shifting, a reversion to the mean, I'll call it. And that's kind of what we're forecasting a little bit. If you look on the far right of the forecast side of the fence, is that as time has progressed, that light green bar has kind of shrunk over in Q2 of 2023, Q3, Q4 is a projection. And you'll notice the darker green, or the S&P 500 earnings, are coming more in line, which may be an opportunity for those more traditional value companies to basically catch back up. And when I say value companies, I always like to think of the Coca-Colas of the world, or the Procter and Gambles, or things that are really well known that pay for owning the stock, or for investors, they pay dividends out to those investors. And then the other thing we're watching, as the markets have been very optimistic, and what we're kind of watching and what we're thinking about is it's bordering on that kind of line of exuberance. And what this chart is showing, or it's a survey for investors of, what is the percent of consumers expecting the stock market to increase over the next 12 months? And if you look, this chart goes back to 1993, December specifically, and we look at December of 2023 on the far right. And it's pretty consistent in that lower range of, 35 to 40 for most of the time. And then if you look on the tail end of that far right column in December of 2023, we have started drifting, quite a bit higher, upwards of 50% based on the most recent survey. And a lot of that shows, just that overall excitement for the markets, which historically is good. But, when we do have signs of exuberance, and I don't know if we're quite there yet, but we're getting closer, we really start to think, okay, are we ahead of our skis, so to speak? And really that's the call for a little bit of discipline, and from an investing perspective, and making sure that maybe there's opportunities for rebalancing in client portfolios, or having discussions about moving things around and making sure that we're all aligned with those risk profiles, and trying to preserve the gains as best we can. And the next thing we want to touch on, because it's always so prevalent, is geopolitics, and how the international world is kind of a chessboard of power players, and how those things are kind of going to shake out. And this chart shows the S&P 500 nominal value, we'll call it, since the beginning of 2020, and just kind of highlighting the different geopolitical events that we've gone through. If we look in 2020, we all are very aware of the COVID-19 events that we had to go through. But if you look even at the peak, on the chart, it's a little small, but we were probably in the range of 3,300 right at that peak. Don't quote me on that. I'm not 100% sure. I'm just extrapolating on the small data. But even through that, we were able to pop back. But then we had the 2020 election uncertainty. We had Russia invading Ukraine in 2022. We had a technical recession in 2023. We had the Hamas attacks on Israel. We had the Trump assassination. We had China encircling Taiwan. All of these things are significant historical events that have caused a lot of uncertainty in life in the future, but it has, the market has still been able to navigate that wall of worry and kind of go through these high pressure, high risk scenarios and come out on the other side and probably a little more efficient, so to speak. And then even if we extrapolate this chart out and we go back years and years, you can look at all kinds of historical data points with World War I, World War II, the Cold War, the Cuban Missile Crisis, 9/11, and the invasion of Afghanistan, and you can go on. And my point really is part of being a long-term investor is there's always going to be a little bit of a wall of worry, or a little bit of a geopolitical event. And part of that's just human nature, because everyone has a goal and we're all trying to, cooperate and cohabitate, so to speak. But sometimes things don't always work out. And then, how do we navigate that as a market, as an investor? And the long story short is, traditionally holding and not making too many large swings has paid off in the long run.
If you look at the bond market, I think we are entering a new era for bonds. For the last few years, the bond market has experienced some of its most difficult years, where for the first time in history, bonds were negative in back-to-back years, to the first time stocks and bonds both finished negative in the same year. But prior to the inflationary period where the Federal Reserve was increasing rates, if you go from pre-COVID back to the financial crisis, Federal Reserve had rates very low, where, as I mentioned earlier, bonds were just not paying very much in interest. The coupon rates, the rate that which a bond is paying you was very low. But if we look back historically, bonds have been a very good avenue for safety, but also income generation. And there's been periods of time where the bond market and bond investors have greatly outperformed equity investors, not just because equities were doing poorly and experiencing bear markets, but because bonds were seeing the rates getting cut, and so we're seeing so much appreciation that the rate cuts were being beneficial. As many of you might recall, when we talk about bonds and the value of bonds, typically the value of a bond is inverse to the change in interest rates. So if interest rates are increasing, the value of your bond at that point in time will fall. If interest rates are being cut, the value of your bond should increase. Ultimately, if you hold the bond to maturity and there's no default, it will still mature and you will still receive your same $100 or $1,000 principal payment back per bond, but the ride along the way can be impactful. Something that we probably heard in the news or seen is, for a long time, the yield curve was inverted, meaning historically speaking, in a healthy economy, the longer the term for the bond, the higher the interest rate the bond pays. If you are going to give a company your money for 10 years, you would expect to receive a higher rate because you're locking that money up for longer than if you are giving your money to a company for 2 years. Over the last few years, though, that has been inverted, where shorter-term rates were paying a higher interest than long-term rates. This has always led to conversations about, is there a recession coming up? Historically, before every recession, the yield curve was inverted, but there's not been a recession every time the yield curve was inverted. So it's an important distinction that I think got lost in a lot of the discussions about the yield curve being inverted. The positive news is, over the last quarter or so, the yield curve is no longer inverted, meaning the 10-year U.S. Treasury is paying a higher interest rate than the two-year U.S. Treasury. Why this can be a positive for bondholders is we're starting to see bonds appreciate in value as interest rates have been getting cut, but I do not believe rates are going to get cut to where they were prior to COVID. So we're hoping and somewhat anticipating that bonds are going to enter a little bit of this Goldilocks range where they're going to get price appreciation from rate cuts, but the rates are going to get cut so low that we go back to an environment where we're just not able to earn much interest by holding bonds. As the Federal Reserve continues to decrease interest rates, we would expect the yield curve to continue to steepen, meaning the rate between a 10-year bond and a 2-year bond continue to increase. Why this is important for savers, for investors, is for the last few years, I think we all have seen, high yield savings accounts paying 5%. Now they're, A lot of them are paying closer to 4%. And so we were, as investors and savers, we're being rewarded to save into short-term vehicles, whether it was savings accounts, high-yield savings accounts, CDs, short-term treasuries. But as rates continue to get cut, that reward is now shifting to the longer duration, longer term bonds, and don't want to miss out on an opportunity to transition funds that were or have been earning a good interest rate and miss out on the opportunity to transition those funds into some longer dated CDs or bonds, and miss out on and get too focused on how do I maximize my yield or interest today to end up in a year later not have the opportunity to purchase or invest in some longer dated fixed income holdings and lock in some of the availability to earn those higher yields.
Yeah, and I think to expand on the longer term, because Tyler touched on the longer term treasury bonds, and really when we dive into the movement in the longer term, or the 10-year specifically, what's driving some of that price action, or why is the 10-year increase? Part of its economic expectations and inflation expectations, but the thing that's been a little more interesting is what's called treasury term premiums. And what treasury term premiums effectively means is long-term bondholders are now demanding a higher percentage of the interest rate for holding those longer bonds. And the reason they would want to do that is when you're holding the longer bonds, it effectively takes you longer to get paid out. And if you're waiting longer to get paid out, shouldn't you innately be compensated for waiting longer or having a higher interest rate than the, let's say, 1 to 2 year T-bills or short-term treasury bonds or notes or things like that? So when we look at, and that's what this chart is kind of showing, it's an estimation of the term premium of the 10-year treasury. And the reason it's an estimation is it's not exactly a observable fact, but if we look, in 2020, 2000, 2004, 2012, and so on, a lot of the average is around 1 to 1.5%, depending on where it falls and where you're looking. But if you fast forward from effectively 2016 onward, that term premium, or investors demanding a higher interest rate for longer duration treasury bonds, that has actually been negative, which is, kind of an interesting relatively new phenomenon. I mean, we go back, this chart goes back to 1996, and 1996 to 2016 is 20 years of, effectively positive term premium, and then we start to divulge into negative term premium. But long story short, of the good news is we're starting to see that term premium creep up to the positive rate, which effectively can help investors or long-term bondholders have that higher yields on those bonds. The potential negative, of course, is if that is going to be priced in, and if we do go back to the historical average of 1.35 on the term premium, that means we do have some room to run potentially for those 10-year bond yields. And if 10-year bond yields continue to rise, that does create, as Tyler mentioned, bond prices are inversely related, or potentially a teeter-totter. As rates go up, the value of your price goes down in the bonds. So that's something we're watching, and it's an interesting dynamic. And if that stays elevated or continues to creep up, it's something food for thought, especially as the Federal Reserve is cutting interest rates. It creates an interesting dynamic in the market. And then the other thing, because when we talk about treasuries, they're U.S. government issued bonds, and those bonds are really issued to effectively pay off the federal deficit, or the debt that the federal government has accruing. And one thing we're watching, and what this chart is effectively telling us is, in 2024, that first chart, or the first bar on the left, almost $4 trillion of that debt, of those treasury bonds, matured, and the government had to pay that out. But if you look at the next line, or 2025, That's significantly higher than 2024. It's almost 2 trillion. It is $2 trillion more. And the government is effectively going to have to pay that out and refinance that debt to keep the government running. And when we're looking at it and we're looking at federal deficits and where things are potentially going in economic growth, the congressional budget does expect that the federal government is going to continue to operate at a deficit for the time being. And then on top of that, they have to renew the $6 trillion in debt on the horizon. It's something that, we bring up the debt conversations and it is a fear, but long story short, though, as well, it's not a huge fear because the U.S. government at the end of the day is not at risk of collapse. Specifically, that is not an anticipation. That's not something that really anyone's calling. And the reason that's probably not true is because the U.S. traditionally has been considered, or U.S. treasuries have been considered risk-free assets, and also the dollar remains the reserve currency for the world. As long as those two things continue onwards, there will certainly be buyers of the U.S. debt because of the strength of the U.S. economy, because of it's backed by the full faith of the federal government and things like that. But one thing to note is with the sweep of the Republican sweep of the Congress and the White House, it is likely that the deficit will remain elevated, specifically because some of the policies that we know from incoming President Trump will probably lean into increase or decreasing taxes, increasing some kind of stimulus package, or things that would provide economic benefits, but usually that's traditionally financed with debt. So we may see, along with the term premiums, a rising of the 10-year, and it's something we're going to be watching closely. And then, in conclusion of our discussion today and things that we're watching or thinking about, we did find this quote from Paul Samuelson, who was a Nobel laureate in economic sciences. He's an American economist. And I think we thought his quote was pertinent. It's that, investing really should be more like watching paint dry or watching grass grow. If you want excitement, take your money and go to Las Vegas. Because over the long term, we are trying to, navigate financial conditions with effectively your nest eggs. And the goal is never to gamble in Paul's example. And it's something we do believe, and we strongly mirror the sentiment. So, and then Tyler, is there anything you wanted to add?
Well, and that is no way an endorsement or encouragement to go to Vegas and gamble. But as Austin said, staying disciplined to long-term investment goals, fundamental investment principles, isn't exciting by design, but is what provides the opportunity for sustainable growth within portfolios, and most importantly, having portfolios aligned to meet your goals, your income needs, your cash flows. I think it is very important. The year is young, the market has started off well, but I think if history tells us anything, there's going to be a few surprises thrown along our way throughout the year, and our job is to not get caught in the swings of the emotions or the markets or the economy, and maintain that longer term perspective. I would like to thank everyone who was able to attend. We're not able to get to the questions, but we'll be reaching out to those who've asked questions. We'll be reaching back out to you to answer those and how it relates to your particular situation. And we will be putting out the recording as well, hopefully early next week. But in the meantime, if you have questions that arise, please do not hesitate to reach out to your respective advisor, and we'll hope and thank everyone for attending, and have a great evening.
Yes. Thank you for attending.